So today's lecture, we're gonna speak about some financial ratios that mostly used in order to analyze the performance of any company. This lecture gonna consist of two parts. The first part, it is, let us say, a theoretical part. At the theoretical part, we're gonna discuss the financial ratios. We're gonna discuss different financial ratios, actually. We're gonna define what do we mean by financial ratios. We're gonna classify the financial ratios into subcategories, and we're gonna illustrate each category and each financial ratio which can be classified under each one of these subcategories. This is gonna be the first part of our lecture. The second part of our lecture, this is gonna be a general speak. You're gonna speak, you are the one who's gonna ask, and Dr. Bassem and me, we're gonna answer your questions. You can answer any questions about the feasibility study, or you can ask any questions related to your study, or whatever questions that you want to ask. So let us now start speaking about the financial ratios and what do we mean by the financial ratios or the financial analysis. In the last lectures, and in different modules as well, or different courses that you have taught, you learned a lot about different financial statements, such as the balance sheet statement, the income statement, and the cash flow statement. I think you should hear about these financial statements in accounting and corporate finance, and in feasibility study as well. You're supposed to know what do you mean by balance sheet, what do you mean by income statement, and what do you mean by the cash flow statement. First of all, my question is gonna be why, before discussing the ratio analysis or the financial ratios, let me ask you a question. And I want to hear from you the answer. The question is, why we prepare 3 different financial statements? Why we have the income statement, why we have the cash flow statement, and why we have also the income statement? Why we do not have a one statement that combine all of these statements together? So this is my question. Who has any thoughts about the answer? See,
I think we talked about that last lecture.
Yeah, you should participate. So,
what is the difference between balance sheet and cash flow and income statement?
Okay, let me check the names. So in that case, I'm gonna ask directly. Okay, we have Ashraf. Ashraf, are you with us, Ashraf? Ashraf Sirriya. Okay, Lara. Lara, are you with us?
Yes.
Yes, Lara. The question was, why we have 3 different financial statements, like the income statement, the balance sheet, and the cash flow statement. Why we do not have a one statement, one financial statement that combine all these data together and give us like an image about the company? What do you think about that? Why we?
I think some investors maybe want to specialize the balance sheet, or about to know about our income statements about the company, or the cash flow of our company, not or the overall. So we can't really combine all these 3 because everyone specializes in something, and I think some investors are more interested in some things like our income. Do we have liquidity? maybe like that.
Okay, Lara, you mentioned a good point. Forget about the investors, but let us discuss. You said that each financial statement has a certain thing, that each financial statement it tell us something specified. For example, the income statement, it tell us, first of all, the revenues that we have, and we can deduct some things from the revenues. But the revenues, we have to focus that the revenues, it combine the cash and the non-cash revenues, isn't it?
Yes.
While in the cash flow statement, we only speak about the cash transactions. We do not speak about the non-cash transactions. Both the income statement and the balance sheet, the income statement and the cash flow statements, it is over time that over a span of time that most likely we are speaking about one financial year, which started from the beginning of the year and ends at the end of the year. While the balance sheet, we call the balance sheet, it's a snapshot financial statement, isn't it?
Yeah.
And the balance sheet, what it shows us, it shows us that the position of the company, but without considering other data from other financial statements, we cannot make a judgment about the position of the company. For example, we could sell a lot of amount of sales, but this is in a non-cash basis. But we want the cash in order to finance our operating activities. In that case, if we only depend on the income statement, so we will make a huge mistake that we will not be able in order to keep our operations running. So this is why we have three. Thank you, Lara.
You're welcome.
This is why we have three different statements. The balance sheet tells us about the position of the company in a certain period of time, not in a specific period, not in a span period of time. While the income statement tells us about the revenues and the cost of the sales, and the cash flow statement only tells us about the cash. It speaks about the cash. Okay, since that, we can expect now that some financial ratios gonna speak about some things related to cash, other things related to the invested capital. Some ratios gonna speak about the time financial ratios. So let us now start our lecture and define what do we mean by the ratio analysis, why we want to analyze some ratios. Now, the ratio analysis involves methods of calculating and interpreting the financial ratios to analyze and monitor the firm's performance. First of all, each firm has its own performance. Who us? We are the investors, we are the shareholders, we are researchers, we are the managers, whatever. We are the stakeholder or the stockholder, whatever we are. We concern about the firm's performance. Okay. Now, how we can monitor and evaluate at the same time the firm performance? Of course, we want some tools in order to evaluate this performance. Okay, we need tools. What tools that we have? We have the financial ratios. So the financial ratios, it is like tools that we can use or calculate in order to interpret the financial performance of any firms. Okay, who's interested in these financial analysis or these financial ratios? We have different entities or different persons that are interested in these financial ratios. All the time we are speak about stakeholder and stockholders. And there is a difference between stakeholders and stockholders. First of all, let me ask What do you mean by shareholders or stockholders? Who can tell me? Hassan, we have Hassan Al-Sadi. This is an easy question.
The investors.
Okay, the investors, the shareholders, or the stockholders, they are the investors. Yes, exactly. Do you know, Hassan, what do you mean by stakeholders? Not stockholders, stakeholders.
Everyone has a mean of the company, like customers,
Yes.
employees, managers, everyone.
Creditors, like the banks. Yeah, thank you.
Yeah.
Thank you, Hassan. Yes, this is the stakeholders. Everyone has an interest in the company. Even the stockholders, they are part of the stakeholders. So the banks or the creditors are stakeholders, the managers, the board of directors, the customers, sometimes the suppliers, they are stakeholders, and they are interested to know about the company. So all of these people or all of these entities, they are concerned, they have a concern in order like to know something about the company. They want to analyze the financial performance or the firm's performance of any company that they are conducted or operating with. Okay, now we have, let me speak about now the types of the data. We're not gonna spend lots of time in order like to discuss the different types of data, but let me tell you like what data that we have. We have something we call it cross-sectional data. Then we have a cross-sectional analysis. It depends on the type of data that we have. We have a benchmarking analysis as well. And we have a time series analysis. What's the difference between these three things? And of course, in advanced cases, we have different types of data, such as the panel data, But let us focus now about the cross-sectional analysis and the time series analysis, and what do we mean by benchmarking as well. The cross-sectional analysis, let us speak about the Palestinian stock exchange market, سوق فلسطين للأوراق المالية. To the best of my knowledge, there are 49 companies that are listed in the Palestinian stock exchange, market. This, if we want like to collect some data about all these 48 companies for the year 2020. So at that case, we call this data a cross-sectional data. And when we conduct an analysis for this data, so this could be, this should be the cross-sectional analysis. So the cross-sectional analysis, it is the comparison of different firms or financial ratios at the same point in time. So remember that I told you that we are going to compare different firms, which is the 49 companies that are listed in the Palestine Stock Exchange market at the same point of time. And the point of time was the 2020. So this is why we call it cross-sectional, different firms at the same point of time. This involves comparing the firm's ratios of those of other firms in its industry or to the industry average. So we're gonna discuss this now when we are speaking about the benchmarking. The benchmarking, it is a type of a cross-sectional analysis in which the firm's ratio values are compared to those of a key competitor or group of competitors that it wishes to emulate. Okay, now what's the difference here? At the first one, in the cross-sectional analysis, we compare all the companies together, like firm one, Bank of Palestine, we compare Bank of Palestine with the Islamic Bank of Palestine, and we compare the Bank of, for example, the Baltel with Ooredoo, for example. So we can compare each company with other companies, but in the benchmarking, sometimes we take the leader or the key competitor, if we are speaking about the banking sector and the Palestinian stock exchange markets, what we are speaking about, who's the key competitor, who's the best bank in the Palestinian stock exchange market. Of course, it's gonna be Bank of Palestine. So at that case, we can compare each listed bank in that market with Bank of Palestine. So what we made, we put Bank of Palestine as a benchmark. Now we put someone. If I want to give you like a very simple example, all the time, you compare yourself with the first of the class. كل الوقت أنتم بتروحوا بتقارنوا أنفسكم بالشخص الأول على الفصل. يعني شخص ما ممكن ياخذ 12 من 20 ويكون مبسوط. ليش؟ لأنه الأول على الفصل جاب 13 من 20، فهو معتبر إنه هذا إنجاز كبير يعني بالنسبة له. فهو عمل الأول على الفصل بالنسبة له as a benchmark. So this is in a simple way how we can define or interpret the benchmark. Sorry, I couldn't see there are some questions. Dr. Bassem, are you with us?
Yeah.
Yeah. Can you please monitor the chats? I don't know what is written there.
Okay, just a minute.
Chat. Yeah, this is chat. How will? Yeah. Okay. Okay, now let me speak about the last type of data, and then I'm gonna tell you how we can find like these types of data in your feasibility studies, or mainly how you can collect these data from your financial statements, which it's supposed to be prepared. So the last type of data that we have, or the last type of analysis that we have, is the time series analysis. Is the evaluation of a firm's financial performance over time using the financial ratios. Now we are speaking about only one firm. If we are speaking about, for example, Bank of Palestine, so we now interested in making some comparisons between the current financial performance of Bank of Palestine and the previous financial performance for Bank of Palestine as well. So in the time series data, we are speaking about only one company or one firm, but over a period of time, So let me now go back to some financial statements. I hope that the balance sheet here, okay. So this is a balance sheet for Partel company. This balance sheet for a specific year. So let us consider this company Y. If we have company X and company Z, and we want like to make a comparison between company Y, company X, and company Z over the same year, then we expect that we have, or we're gonna conduct a cross-sectional analysis. But if this analysis for Partel company, and we have data for, or the balance sheet for this year, 2020, and the last year, 2019, the previous year, 2018, and the one before, 2017, and etc., till we reach the year 2000, for example, then at that time, and we want to compare or to make a comparison between each year, the financial performance of Partel company for each year, and make a comparison that this year the company, the performance of the company is good, but the last year it wasn't good, the year before it was like quietly good, and etc. Then at that time, we are speaking about time series analysis. This is gonna consider as a time series analysis. Now, we spoke about a cross-sectional analysis, time series analysis, and a benchmarking analysis. This figure can give us two types of analysis. The yellow line is, we can speak of this is the average collection period for days. Let us consider this as a financial ratio, for example, and then the yellow line represents time series analysis, and the blue line as well, a time series analysis, but for the industry that Bartel is listed. But if we want to compare the Bartel company with the industry, then at that time we are speaking about, or we're conducting a benchmarking analysis. Now, this is in a simple way how we can define the financial ratios. So the financial ratios, consider it as a tools that we use in order to assess, to evaluate, to monitor the financial performance, or the performance, or sometimes not only the financial, the overall performance of a certain company. Okay, what financial ratios do we have? We have like different categories. We can classify the financial. Do you have any questions before I continue? Anyone have any question till now? Don't be shy.
Is everything clear that Dr. Abdurrahman said, or you would like to have or to ask any question? Okay, you can go on.
Then we can continue. Now we can classify the financial ratios into different subcategories. We have the time-based ratios, liquidity ratios, activity ratios, debt ratios, profitability ratios, and the market-based ratios. So why we have different ratios? We have different ratios because, again, each ratio tells us a different story about the company, a different story. And each ratio compare the company sometimes with itself and other times with other companies. Like sometimes we can conduct a time series analysis, other times we can conduct a cross-sectional analysis, and lastly, we can make like a benchmark analysis in order like to evaluate the company relative to other companies. Let us start with the time-based ratios. I'm gonna speak only about the payback period, which is the most, for me, it is one of the most important ratios. And this ratio, mainly it is very important for micro enterprises and small enterprises as well. Because each one want to recover his initial investment, which is the invested capital in a project in a short time or in a short period. So what do we mean by the payback period? It is the time that we recover our full investment. For example, if I want to open a barber shop, salon coiffure, salon hilaqa, or salon coiffure. So I'm gonna invest a certain amount of money in that barber shop, and I expect that the barber shop will recover or will give me back my money or my invested capital within, like, for example, 3 years. So I expect after 3 years, whatever I have invested in that barber shop, it is gonna be in my pocket. It is gonna be in my pocket. Okay. The question now, which is better? If the payback period is very high, like 10 years, 12 years, or very short, 1 year or 2 years. So this is the question. The answer, the payback period, we can't make a judgment about the payback period without comparing the project with another benchmarks or with the industry itself. because we can't compare like a barber shop with an automobile company, for example. Why? Because the automobile company, we know that the automobile company require a huge amount of invested capital in order like to run. While the barber shop, it required like a slightly not large or a small amount of money. So at that case, I expect that the automobile company require like maybe 10 years or 12 years as a payback period. My invested capital will be again on my pocket after 12 years, while in the barber shop it is gonna be the money gonna be in my pocket after 3 years. So, but the comparison here unfair. We have unfair comparison. So, how we can calculate the payback period? How we can calculate the payback period? First of all, we have two ways in order to calculate the payback period. If we have like a constant, annual cash flows, so at that time we can divide the initial investment invested, which is the capital that we already invested in the company. We can divide the initial investment over the annual cash flow. Okay, the initial investments, we know how much capital we put in that project, but the annual cash flow, we can like bring that or collect this data, the annual cash flow, from the cash flow statement. So we are interested on the net cash flow, which exists on the cash flow statement. So if we have, like, for example, this example tell us that the total invested capital is 760,000 pounds, because I was in the UK, supposed to be US dollar when I was here in Gaza. Anyway, so $760,000, we should divide this amount over the annual cash flow. But here we have a constant cash flows. What do I mean by constant cash flows? That year one will give me a net cash flow of 200,000. Year two will give me 200,000 again. Year three, 200,000 again, until I reach each year gonna give me 200,000 pounds as a net cash flow. In that case, it is very simple. I divide the initial investment over the annual cash flow and the number that results. So in that example, the number is 3.8, which means that the payback period for this project gonna be 3.8 years, roughly maybe 3 years and 9 months, maybe 3 years and maybe 9 or 10 months, something like this. So this is the payback period. But what if we do not have a constant annual cash flows, which means that the year one, we have a different annual cash flow from year 2, year 3, year 5, and year 6, and etc. So this example show us what if we have, this is new Israeli shekel, okay. This example, we have like the same amount of invested capital, and we have here a different annual cash flows. What we have to do? Is we have to deduct نطرح each annual cash flow starting from year one from the invested capital. For example, the annual cash flow for year one equal 200,000, and the initial invested capital is 760,000. So 760,000 minus 200,000. The result gonna be 460,000. Now again, we have to deduct the second year, the annual cash flow of the second year, which is 230,000 from the 460,000. The result is gonna be 230,000. So This example here gonna tell us exactly how we gonna operate this one. How we gonna operate this one? But there is a mistake here, I think. No. Yeah, this one. Oh, sorry, 550,000. 550,000. This is a 550,000. So this is the lifted amount of invested capital. The second year after I deduct the 230,000, the lifted amount of invested capital gonna be 320. Then I deduct the third year annual cash flow, net cash flow, and what remains is the 120,000. And the fourth year, the net cash flow was 180,000, and till I reach the minus here, till I reach the minus. So now I can say we can divide this minus over the number of months, and it's gonna tell me how many months are lifted. So again, this is 3 years and 8 months. 3 years and 8 months. So I think you already know about the payback period and the last lecture, or one of the last lectures. Now let us move to discuss different financial ratios. Let us speak about liquidity ratios. Now we have two different ratios, which is the current ratio and the quick ratio. Just to tell you that after 3 or 4 minutes, the Zoom gonna be disconnected, and we will reconnect again. So for the liquidity ratios, we have, first of all, the current ratio. The current ratio measures the ability of the firm to meet its short-term obligations. So the current ratio, also sometimes we call it the working capital ratio. And it is mostly used to make sure that a company is able to pay off short-term debts. So mainly we are speaking how we can settle down our short-term debts. What do we mean by short-term debts? Like account payable, like electricity bills, internet bills, etc. All these like short-term liabilities. So what do we mean now the current ratio? Again, we said that it measures the ability of a firm to meet its short-term obligations. So how we can meet our short-term obligations? Of course, by cash, but not only cash. We have a liquid assets. So we're gonna include all liquid assets, which appears on the balance sheet as known as the current assets. So all the current assets, which represent the liquid assets that we have, we can divide the current assets over the current liabilities. So the current liabilities, we are speaking about current liabilities, and again, now we can think about the definition of the current ratio that measures the ability of firms to meet its short-term obligations. So now, how I can use the liquid assets in order to settle down or to pay off my current liabilities. Now, we have example. This example on the balance sheet that I show you, these numbers, it appears on the balance sheet that I show you. So we divide the current assets of this company, Partel, over its current liabilities, and the result is 1.97. Roughly, it is gonna be 2. Now the question is whether the current ratio, what is better for us, to have a high ratio like 3, 4, 5, 6, or low ratios. After the connecting again, because it's gonna disconnect in a less than a minute. After connecting, we're gonna ask this question again and answer it. Dr. Bassem, can you make a new Zoom meeting, please?
Yeah, I will exit this one and we'll reconnect.
Thank you very much.